Today let us discuss about the balance sheet. What is balance sheet? Balance sheet is a summary of company's resource structure and the financing structure as of a particular date. We have three elements of the balance sheet. We have the assets, the liabilities and the equity. Asset is your company's resource structure. Liabilities and equity is the company's financing structure. The balance sheet is like a photo. It's a snapshot of the company's financial position. The balance sheet accounts are permanent accounts. So the permanent accounts are the assets, the liabilities and equity. So what do we mean by the permanent accounts? The permanent accounts are the accounts that are not closed at the end of each accounting period. The balances in the permanent accounts are cumulative. That means the balances are carried from one accounting period to another. For example, if you have bought a machinery in year 1, for example, $50,000, year 2 the value can decrease because we have depreciation or something. The value of machinery can decrease to 40,000. Year 3 the value can decrease to $30,000. So this what happens in year 4. Year 4 also we have some value, right? From 30,000 let it be 20,000. So what happens, from year 1 we are carrying some value to year 2, then from year 2 to year 3, and year 3 to year 4. This is what is meant by this statement, that it's not closed at the end of the accounting period, and the balances are cumulative and the balances are carried from one accounting period to another. We have three elements of the balance sheet: the assets, the liabilities and equity. So let us discuss the first element of the balance sheet, which is the assets. Asset is also known as item of value. Asset is what the company owns. An asset is the probable future economic benefits that results from past transactions or events. They are the resources available to the organization so that the organization can carry out its purpose. The assets are presented on the balance sheet in the order of liquidity, and we have two general categories of the assets. We have the current assets, and the second category is we have non-current assets. So we have two general categories of assets: the current assets and non-current assets. So how assets are current assets? If it meets certain definitions. So current assets are the assets expected to be realized in cash, sold or consumed within 1 year or the operating cycle, whichever is longer. So this is the definition of current assets. Whatever meets this definition is your current assets. So the examples of current assets are cash, we have accounts receivable, we have marketable securities, we have inventory and prepaid expenses. Non-current assets. Non-current assets are the assets which are not current assets or which does not meet the definition of the current assets. The examples of non-current assets are long-term investment, we have restricted funds, property, plant and equipment and intangible assets. So these are some of the examples of non-current assets. Now let us discuss about the second element of the balance sheet, which is the liabilities. Liabilities is also known as debt. Liabilities is something what the company owes to others. Liabilities is the probable future sacrifices of economic benefits that results from past transactions or events. Liabilities are the third-party claims to the assets of the organization. The liabilities are presented in the order they come due, and we have two general categories of liabilities. We have the current liabilities and non-current liabilities. So how you define the current liabilities? So current liabilities are the liabilities expected to be settled within 1 year or the operating cycle, whichever is longer. So the examples of current liabilities are accounts payable, we have accrued expenses, wages, utilities and rent. Non-current liabilities. So non-current liabilities are the liabilities which are not current liabilities. And the current liabilities can be converted to non-current liabilities if certain criteria is met. If the company is able to demonstrate that it has the intent to refinance, so first criteria is that it should have some intent, right? intend to refinance on a non-current basis, and there must be an ability, intent and ability, and that must be shown that the company by that must be shown by entering into a refinancing agreement, and that must be before the balance sheet is issued. So there is certain criteria. If this criteria is met, you can convert your current liabilities to non-current liabilities. Now let us discuss the difference between the assets and the liabilities. Asset is what the company owns. Liabilities is what the company owes to others. The first difference. The asset is the item of value and the liability is the debt. Asset is the probable future economic benefits. The liability is future sacrifice of economic benefits. The similarity is that post results from past transactions of events, past transactions or events. Asset is the resource available to the organization, but they are third-party claims. Presentation. They are presented in the order of liquidity and they are presented in the order they come due. So both is having two general categories, the current assets and non-current assets, and we have two general categories of the current liabilities, which is the current liabilities, and we have the non-current liabilities. The third element of the balance sheet is the equity. Equity is also known as net worth. Equity is the ownership interest in the business entity. It's the amount that would theoretically be distributed to the owners if the company were to be liquidated. Equity is the residual interest in the assets after deduction of liabilities. Uh, this is what it means, that it is the difference between assets and liabilities, and equity is equal to assets and liabilities. So it's a residual interest if you deduct the liabilities from your assets. So the liabilities, if you deduct the liabilities from your assets, you are going to get the value of equity. This is what it is explained here in terms of a sentence. Residual interest in the assets after deduction of liabilities. What you get after deduction of liabilities, you get equity, and that is the residual interest. And equities also can be called as the difference between the assets and the liabilities is your equity. There are certain terms in the stock which we need to know, that is stock authorized, stock issued, and stock outstanding. So what is stock authorized? Stock authorized is the maximum number of shares a corporation is legally can legally issue. So for example, a corporation can legally issue shares like 150,000 shares. The company can, this is the maximum number of shares a corporation can issue. And the stock issued is that the number of shares that have been issued from the authorized stocks. For example, the maximum number of shares a corporation can issue is 150,000, but it has issued only 100,000. So this is a stock issued. A stock authorized is 150,000. Out of 150,000, we have issued 100,000. And out of that 100,000, what happens? Only 80,000 shares has been purchased or held by the shareholders. So number of issued shares currently held by the shareholders is 80,000. So this is the difference between stock authorized, stock issued, and stock outstanding. On the balance sheet, the equity is presented in the order of liquidation. We have different categories of equity. What are the different categories? We have the preferred stock, we have the common stock, we have additional paid in capital, retained earnings, accumulated other comprehensive income, and we have the treasury stock. Preferred stock have no voting rights. The preferred stock does not have preventive right. Preferred stock usually get a dividend that is fixed percentage of the par value. There are many types of preferred stock, but generally the preferred stock is of cumulative and non-cumulative. Cumulative is that if the organization paid dividends, and if the organization does not pay dividends. For example, if the organization does not pay dividends, that dividends must accumulate, and that must be paid before paying to the shareholder. So you pay dividend, you don't pay dividend, but in this cumulative preferred stock, you have to pay the unpaid dividends plus the paid dividends. So this is what the cumulative preferred stock is. Non-cumulative preferred stock does not accumulate unpaid dividends. No future claims for skipped dividends. So these are some of the types of cumulative and non-cumulative preferred stock. Common stock has voting rights. They have preventive right and highest risk. Preventive right we can understand from the MCQ section of the balance sheet. So we'll understand what it is. Additional paid in capital. Additional paid in capital is the amount received by the organization for the stock over the par value. Over the par value, whatever amount that has been received, that is going to an account that goes in an account called additional paid in capital, or in short form we call it as APIC, additional paid in capital. We prepare two statements. We prepare the income statement and we prepare the OCI. OCI is other comprehensive income. So whatever amount you get in the income statement, that is close to your retained earnings. And whatever income you get from the other comprehensive income, the other comprehensive income is close to the accumulated other comprehensive income. So it is called accumulated other comprehensive income, and income statement amounts are close to retained earnings. Now we have treasury stock. Treasury stocks are the repurchase shares. We don't, they are our own stocks. So that's why our own stocks we can't pay dividends. So no dividends paid to the treasury stock. We have no voting rights. The treasury stock is not outstanding and it's a contra equity account. Contra equity account means it's the deduction of the equity section of the balance sheet. For example, preferred stock will have certain balance. For example, if the preferred stock is having 30,000, preferred stock, common stock is having 10,000, or retained earning is having 5,000, accumulated OCI is having 2,000, and treasury stock. So treasury stock is in red. 10,000. So it's a deduction. Treasury stock is a contra equity account and the balances is deducted. So that's why treasury stock is shown in a red color. So whatever the balance is, the balance will be the equity section of your balance sheet. Accounting equation. Accounting equation is assets is equal to liabilities plus equity. So your assets should always be equal to liabilities plus equity. So a company's total assets are always equal to sum of its liabilities and its shareholders' equity. This accounting equation is based on the proprietary point of view. So what is proprietary point of view? So whatever remains, the proprietary point of view is that whatever remains belongs to the owners of the business. The accounting equation is also called as the basic accounting equation, or it is also called as the balance sheet equation. And the balance sheet equation must tally. Assets should always be equal to liabilities plus equity, and these are the three elements of the balance sheet we have already discussed. Asset is one of the element of balance sheet, liabilities is one of the element of balance sheet, and equity is one of the elements of the balance sheet. Liquidity. One of the benefit of balance sheet is liquidity. Liquidity measures the short-term paying ability. Liquidity is the company's short-term paying ability, and solvency is the company long-term paying ability. So you can understand the company's short-term paying ability, you can understand the company's long-term paying ability. So how you are going to understand the short-term paying ability? By calculating the current ratio and the quick ratio. You can understand the long-term paying ability by calculating the debt to equity ratio. The another benefit of the balance sheet is financial flexibility. So financial flexibility means how how you can take the opportunities that are available in the external market to respond to unexpected needs and take advantage of opportunities. So how financial flexible you are. So this is one of the benefits of balance sheet, that it gives you it gives you that how it gives you to judge how the company is the company financial flexible or not, is the company can take the advantages of opportunities or not. Now, by looking at the balance sheet, we can evaluate the capital structure. We can compute the rates of return. So how we can remember the benefits of the balance sheet? We can remember it by combining it, that we can assess the company's liquidity. Liquidity is the short-term paying ability. Solvency is the long-term paying ability. We can know the company's short-term paying ability. We can know the company's long-term ability, and we can understand the financial flexibility, how flexible the company is, whether the company is going to take the advantages of opportunities or not. We can evaluate the capital structure, how much proportion of debt or the equity financing is. We can compute the rate of returns, like return on assets or return on equity. Limitations of balance sheet. There are certain limitations of balance sheet, and they are, there are many assets that are not reported on the balance sheet. They are omitted on the balance sheet. For example, we don't report companies, employees, or human resource. We don't report customer satisfaction, and we don't report the brand image. So these items are not reported on the balance sheet. So this acts as one of the limitations of balance sheet. Many assets and liabilities are recorded at historical costs. So if we are recording at historical cost, that may differ from the current market value. So if it differs from the current market value and we are recording at historical cost, so this is one of the limitations of balance sheet. The balance sheet is prepared using management judgment and estimates. So, while preparing the balance sheet, we use certain estimates and judgments, like what depreciation method we are going to use, what is the allowances for credit loss, like percentage, 4%, 3%, 2%, 10%, what method of inventory you are going to use, what with the costing, like first in, first out, or life, or average, or we can get a specific method. So there are certain judgments and estimate are used in accounting, that is that acts as one of the limitations of the balance sheet.